A Fed rate cut can move stock markets across the world. Here's the simple explanation of how it affects the US and Indian markets. Why US markets react first. A rate cut makes money cheaper for companies and investors. When interest rates fall, companies pay less on loans and debt. Lower interest cost increases profitability, which makes stocks more attractive. US market sectors gets affected first. Tech and growth stocks benefit the most from rate cuts because they depend heavily on cheap capital. Banks may not benefit much because lower rates reduce their lending income. Real estate, automobiles, and consumer sectors often get a boost from lower loan rates. How it impacts India. Foreign investor flows are a big driver of Indian market movements. When the Fed cuts rates, global investors put more money into emerging markets like India. A weaker dollar makes Indian stocks more attractive and cheaper for foreign investors. Which Indian sectors benefit? Indian IT companies depend on US clients, so rate cuts can boost demand for their services. Banks and NBFCs benefit from strong credit growth when rates fall. Consumption stocks like auto, FMCG, and real estate may see higher growth. Combined impact. A rate cut improves market sentiment, triggers rallies, and reduces fear. Short-term volatility is normal before and after rate cut announcements. Conclusion. When the US cuts rates, India feels positive impact through FII flows and global sentiment. Watch Part 4 to learn which investments may benefit the most during rate cut cycles. Hit subscribe for more such content related with investment, finance and crypto.